Wealth Creation Using Property Pros and Cons. I'm a chartered accountant licensed to advise on superannuation. I will be presenting this webinar jointly with Paddy Boyle, mortgage broker, and Ashish, the buyer's agent. Before I go ahead, just a disclaimer, this advice is general in nature and does not take into account your personal circumstances. So let's get started. So when we invest into the property, your strategy is the most important thing. Generally, I see people asking the question, how many properties should I buy? Should I buy 5 properties? Should I buy 6 properties? That is not the right question to ask. The right question is, what is your strategy? Why are you buying the property? Why are you into this property investment? When you answer your strategy question, then you go ahead and decide how many properties do I need and how much should I invest. For example, the purpose could be, I want a certain retirement income. I want $100,000 retirement income, and I am going to retire in say 20 or 25 years time. We are starting with the end purpose, and then we are moving to the current time. That is a strategy, and then you can decide how many properties or what value properties do you need. Continuing with that strategy, if you want a $100,000 retirement income, the golden rule is 5%. If you start a retirement, a pension income from your property, if you start with the 5% value of your investment, for example, if your investment value is 2 million and you start with 5% $100,000 income in the year 1, and you index that income subject to the CPI, the golden rule is that your investment will last around 25 years. It will be 25 to 30 years. So that is something you can decide. If I wish to retire at 65 and I want $100,000 income, that income to last for 25 years, then you are okay with a portfolio of 2 million in properties. Then you decide, what do I buy? How do I diversify? Where can I achieve that desired growth? And once you decide that, then your aim should be to repay the loan, continuing with that strategy before your retirement. Then you achieve your strategy, you are on track, your capital growth and the cash flow from the properties will help you to achieve your strategy of a 5% income of your portfolio indexed for CPI every year, running for 25 years. So this is one example. That's how you should start, rather than deciding, look, I have 5 properties, I want to buy 6, I want to buy 7. If we move further, we also get asked the common question, what should be the ownership structure? How should I buy the property? Is it going to be in my personal name? Is it going to be in a discretionary trust, or is it a super fund? Again, it comes to the strategy and how easily can you achieve the strategy. The most common structures other than buying in your personal name are the discretionary trust and SMSF, self-managed super fund. If we quickly touch both of them, in the discretionary trust, the negative gearing advantage is not there. But again, that should never be your strategy. Your strategy should be much bigger than a short-term negative gearing for 2, 3, or 5 years. You get a much better asset protection. Depending what you do professionally, you might be in a risky profession. When you separate the assets, the properties in a structure compared to your business or your personal name, you get a better protection from the unsolicited claims against your business or yourself personally. The other common advantage is that you can distribute the income from the property within family members. But just keep in mind, there was a recent ruling when tax office came out and said, if you are distributing income from a trust to your adult children, unless you physically pay them the money and don't take the money back, tax office is going to target those distributions. The second popular structure, which is very tax friendly, is the self-managed superannuation fund. The borrowing structure is a bit complex here. You need to set up few separate structures to borrow money to buy property in the SMSF. But in the long run, it is much friendlier. the tax rate is much lesser. And once you retire, when you start drawing your income, in most of the cases, you would not be paying any income tax. Just keep in mind, if you are buying multiple properties, SMSF restricts, the rules restricts in the SMSF to use equity against one property to borrow money or to use as a security against the second property. So if you are aggressive in the acquisition to fulfill your strategy, then you might not be buying properties in the very short term in the SMSF. Again, when you retire, if you sell the property at that time, in most of the cases, there won't be any capital gains tax either, given it is a tax-friendly environment. So these are the common questions I get asked: how many properties should I buy? Where the purpose should be, what strategy is there? And what structure should I use to buy the properties? And now I will pass on to mortgage broker Paddy, who can answer the questions, sorry, who can present the common topics for the loan. And then Ashish, after that, we can come to the questions for all of you. Thank you. Over to you, Paddy.
Thank you, Shiv. Can you hear me?
Yes.
Beautiful. Thank you very much, Shiv. That was really good. And building on what you just said, that is the first point, your accountant just to help you set up a strategy. And then you actually go on the acquisition strategy, you know, what to buy, where to buy, how to actually go about funding it. So for those who don't know, my name is Paddy. I'm a mortgage broker. Prior to this, I was a financial planner at AMP. I've been in the finance game for about 12 years. Started my role as a bank teller at CBA. Worked my way up to becoming a planner, and I run my own mortgage book now. Before we go into the detail, because we will be discussing quite a lot of wealth strategies and all of these products are regulated, it's important to know that all the information is factual and general. Before you go out on your way, don't rely on Google, go and talk to a professional so that you know exactly what you're doing. Next slide, please, Shiv. Now, building on what Shiv said about how many properties to buy, your retirement income goal, the next step after that, which I really help my customers is like how to actually go about structuring. For example, do you want to buy under your own names, or are we better off, you know, going the path of something like a trust, or where does self-managed super fund or a company structure sit in? When the customer comes to us, we need to really look at holistically what they are looking to achieve, whether those properties or assets they're building for themselves, for their retirement, or is it something they want to pass on to their children? That's where all these four categories will go through them today, just to explain how those kind of in a real world scenario work on. So the first one is trust. That's one of my favorite one. It's actually one of those ones that is highly recommended by accountants to, you know, people with, for example, one partner is working quite a lot of money and the other one's not. Those are the scenarios where we'll push them back to, you know, have a chat to your accountant first, just to understand whether you're better off just buying under your personal name, or are you better off looking at, you know, something like a family trust or a holding trust. Trust in simple terms works quite differently, but from a home loan perspective, works similar to your individual loans, right? So they look at how much loans you have, and they'll work out your borrowing capacity. A couple of typical ones are, if you have a family, you know, partner's not working or partner's working, you can actually pull together your borrowing capacity, your deposits, and really leverage off that to actually build a really decent sized portfolio. So another big one we see is brothers. So rather than just pulling all your, you know, borrowing capacities into individual names, you'll go and look at, you know, okay, well, are we better off setting up individual trusts and then going and buying those assets? So these legal structures are quite important. From a home loan perspective, they work similar to individual scenarios. So we'll touch on in the next slide on that one, Shiv. So some of the questions we get, if I look at a loan for a trust versus just borrowing under my name, works quite similar. It is similar deposit requirements. You can walk to a bank, You just need 5 or 10% deposit. Works quite well. Banks can generally lend, for example, ANZ, Macquarie, they can easily lend up to 90-95%, quite easy to deal with. Borrowing capacities worked out exactly similar to how, you would borrow against your name. So they'll look at how many loans you have, work out your borrowing capacity. One of the big ones, and how trust can really help you leverage and buy more and expand your portfolios, you can actually pull together family members, friends, if that is, something you're looking to do. So once you've, let's say, exhausted your own, or if you're building wealth for your whole family, we actually see quite high net worth customers. They actually rely on a trust structure a lot more because it gives them that freedom to move around assets without triggering things like capital gains and all that stuff. So passing on wealth to your family becomes quite easy, but you can't really set it up after you've already bought the property. So these discussions need to happen before. So that's when a customer walks to us, we try to understand what they are looking to do. If you don't have a plan, that's fine. That's part of our job to just educate you and nudge you in the right direction. If we go to the next slide, Shiv, we'll quickly touch on the company structure. It's quite rare. It's not one of the widely used structures. It's quite popular amongst property developers, or it might be quite popular with people just trying to flip properties, for example. So rather than going to a bank and asking for 2 million to develop a piece of land, what they might do is they might have their own family trust, pulling together resources, borrowing capacity deposits, going and setting up a holding company. That's where the asset which you will buy will sit. The key benefit there is you're leveraging your deposits. So in this example, as you can see on your screen, there's 3 family members. They go and buy a plot, and they're going to subdivide it. They're going to sell it. All the assets sit under the holding trust. Before you decide and go something, do anything like this, just have a chat to the accountant, just try to understand. And before you set up the holding company, just reach out to a mortgage broker just to make sure you set it up in the right way, because there's certain requirements on who can be the director and so forth. Again, not very widely used one, but that is that once you venture out into bigger and better projects, this is something you might be looking into. If we go to the next slide, Shiv, this is my favorite one, self-managed super fund. We see all our high net worth customers, especially with big incomes and they're really setting themselves up for retirement. Self-managed super fund is always part of their strategy. Now, they start very early, being on high incomes. They're able to accumulate quite a lot of superannuation. Once you reach that sort of space, and you don't want to be working way past your 60, 65. So having a self-managed super fund strategy early in the piece works out quite well. Now, it's, as she mentioned, quite a regulated field. So there are restrictions on what we can do, what we can't do. But what we'll talk about today is just what sort of loans structures look like. So if you go to the next slide, some of the questions we get: how much deposit we need, how much can I borrow? Those are the 2 main ones. But gone are the days when you could walk into a bank and get, with a 5% self-managed super fund loan. They generally only lend up to now 20. You need at least a 20% deposit. So if you are looking at a $500,000 property to buy something, you're going to need a 100K plus stamp duty cost. That's why we encourage our customers to go and have a chat to the accountant. June, July, before June, July, after June, July, those are the ideal spots to actually really start building up and talking to the accountants to leverage. ATO recommends 200 grand, but the accountant probably could tell you a bit more about, what those are and how those discussions look like. There's a bit more involved in managing a self-managed super fund. So don't try to go and pay someone quite a ridiculous amount of money and then you realize that's too much work for us. Now, borrowing capacity is another one that comes into us. How much can I borrow? Now, it's actually quite simple. The good thing about how self-managed super funds can help you buy more properties is borrowing capacity within a self-managed super fund is completely independent to your personal borrowing capacity. What I mean by that is you could have 10 million lending under your name. You could go into a self-managed super fund and start from scratch. The way the borrowing power is calculated is based on what kind of asset you're going to buy, how much rental income that then it's going to produce. For example, if you go and buy a shop and that shop is giving you 60 grand a year in rental income, that is money we can use to service that debt. On top of that, how much, if you are a PAYG, like you're working for someone and they're paying you super, that also helps you boost your borrowing capacity. If you're working for yourself, you can actually control how much going in. So that's why before July, after July, you can really talk to your accountant, really develop something that can actually help you down this path. But we've seen a lot of the customers don't know about it, but a lot of the high net worth customers, that is in forefront of their mind, and they're actively pursuing what they're buying. What kind of properties are held with our customers? Most of our customers who own a self-managed super fund generally have commercial exposure. So they'll have shops, factories, and quite those kind of assets, that you may not see in a personal space, in an individual capacity. Now, the reason is sometimes a lot of the high net worth customers, they may have a lot of personal lending under their personal names or trust. They may already own a couple of residential properties. Then it's just to diversify and have a different kind of exposure. But it's quite common for a lot of SMSFs to own things like factories, shops, all those commercial types of warehouses and stuff like that. Residential is there. Just be mindful, you can't go and build a home. That is quite a common one. Can I build a home using a self-managed super fund? There are ways around it, but if you go to a bank and go, I want to buy land and then I want to build a house on it, that's not going to happen. There are restrictions. You have to acquire one asset, but there are companies out there that can actually help you deliver a finished product, and you can go and buy that finished product and you still get those, depreciation benefits and so forth. So there's ways around it. Obviously, any service like that's going to cost money, but if that's something that you want to get exposure to, there are ways around it. If we go to the next slide, questions, we'll leave that with you, Wayne, and we'll park this one for now. If you want to be in touch with me, we look after all kinds of home loans. Being an ex-finance planner, I'm quite focused on the strategy and where you want to be, not a tick and flick broker who's just going to go in and write the loan and never talk to you. We really set you up for year 1, year 2, year 3, year 4. We are interested in, getting you from, and most of our customers are multi-property portfolio customers. They on an average have about 2+, and that's where we want our customers to be. Now we'll pass to Ashish, who will give us a bit of an overview on, now we've understood what kind of income we need. Now we've understood how to actually get it funded, but the real money is made when you actually go and buy an asset, not when you sell it. So it's important to understand the acquisition of that asset, and that's what Ashish is going to touch on.
Awesome. Thank you, Paddy. Hi, everyone. My name is Ashish. I run Oswald Buyers Agency. I'm a buyer's agent by profession. Real estate is my passion. So just a bit on what my logo depicts, which is flourish, protection, growth, and passion. Pretty much what other professionals in conjunction are doing as well. Shift to the next slide, please. Hi, as Paddy has said, this is just general advice without taking into consideration your personal circumstances. And then I would love to pay respects to the elders past and present, to the traditional custodians of various landowners, the Aboriginals and Torres Strait Islanders. Yeah, so what my why is, why I'm doing what I'm doing. Would love my family to keep the backbone of what I'm doing. Love giving back to community, either in terms of sponsorships or donations, which I'm in a good position to do. A bit of a freedom and passion. Real estate is my passion, which I have been doing for the last almost 8 years. Awesome. So as committed, I'll start with quickly the type of assets that can be targeted, which is to defy most negative economic events. So you cannot control the rate interest rises, you cannot control other economic events, but what we can do is just target the right assets in the right areas which are well placed for growth. This, for example, one asset is bought right next to a surf beach. Again, if we go to the next slide, we'll see in detail what we look at. So this is the asset. As you can see, the left picture shows how wide the driveway is, which means it has the potential to add another dwelling at the back. Now, the same dwelling, I'm just showing what's at the back. If you can see, it's a duplex built at the back, which can be could have been seen with the right tools and resources. So, which also means this is a 700 square meter block with more than 18 front. The client wanted something to add value where they can add value. And then because the asset or the house has so much of value add, there are developers interested for the same property. There are many other lifestyle investors or owner occupiers interested. I don't think one can go wrong with the property, of course, backed with other strategies and demand in place. We also went in pretty early in this property, which means it was already undervalued. And with the increases, the current valuation has gone up nearly $100,000. And it's just been 6 months since we bought this property. There would be more examples later, but many assets have 1 or 2 or 3 or more of such value adds. Now, as Shiv and Paddy have highlighted the importance of having a strategy in place, because many times you need to have certain income with the property or certain growth in order to keep buying. It's not about the number, it's about your goals, which can be built in conjunction with other professionals. Now, I'll just give you a few examples what we've done for the clients. And this is again after they've got specific advice from accountants and brokers. I've just taken an example, client Mr. SS, who had a fully paid out home, but no passive income or low passive income, $1.8 million in line of credit. What we've done is we've devised a strategy whereby they wanted to have 4 or 5 properties in place, but they didn't wanted premium assets because, again, based on the assessment, they were a bit risk averse. As professionals, what we've done is the first property we bought in October 2020 in Victoria. This was a brand new property under their super, giving them enough depreciation and other benefits. Also super because the rate of interest is higher. They wanted some cushion with respect to rental as well. So with brand new, almost achieving 5.2% rental yield, we bought in October 2020, which is about 1.5 years now. The property has given more than 40% growth. The second purchase was done in South Australia. The intention was also to diversify in the right markets. And the client has been lucky enough or is very quick in decision making as well, which has benefited both the client and myself as well. We've gone into every single market very early on. When I say market, not necessarily the state, but the respective suburb as well. So the second property bought is a fully renovated home, a 3-bed, 2-bath, just a carport, but bought for 420. Similar properties, because of the potential we've identified, it's a 700 square meter block again. It gives you the potential of adding 3 row houses or a duplex, but nothing needed because it's already giving 5.35% rental yield. The third one we bought in Queensland. Again, as you see, the client wanted to understand the numbers in the first purchase, and then they were very comfortable. We had a bit of repo build. The third purchase, as you can see, the left-hand side is actually the garage. This house was DA approved for an additional dwelling. However, all of this potential does not come at a cost. So we bought a corner block, $480,000. It's renting out for $450 a week. And this was also a renovated property with a separate garage. It's not costing the client to hold. So my client decided that they're going to hold it for a decade or so, and then they're going to build duplex on it. If we can go to the next slide, Chip. So the outcome is 1.4 million invested. 1.8 million in current value. In last 1.5 to 2 years, I've been associated with the client. I've been able to give them 30% growth by investing in the right areas and the right assets. That's the importance of strategy. The cash flow is nearly 25,000 positive at this moment. Now, he's ready for his fifth purchase as well, which we are now finding in WA. Again, just to utilize diversification, but the purchase for is not included because it's a development strategy. The client still has taken loans and they still have a bit of cash reserve, whereby they wanted to add value to their son's portfolio as well. And this development, their son's managing with me at the moment. Again, development numbers also stack up pretty well. Now, this is another example whereby client, couple, no kids, dual average income, early 30s, but their focus was on lifestyle and health, and a bit of depreciation, which again, the inputs came from the accountant and the broker. The first and the second purchase, fairly new properties, the yields are nearly 5% plus. The LVR, as you can see, started at about 90% and now averaging around that 60% mark. Yeah, so the outcome is about 835K invested. Already they are in a benefit of nearly 400 and something $1,000. They've also taken the equity out once, $80,000, which they've invested in shares for having a more balanced portfolio. So the property has served a good medium for them. Growth, if you just focus in last 4 years, has been nearly 60% with a very decent deal. Including depreciation, they are able to claim about 20,000 back after all expenses. Again, they've been able to manage their lifestyle. They've been able to diversify into separate assets and they have a balanced portfolio. The clients are now ready for their third purchase, which we'll be discussing soon after the Easter break. This one last example is for an owner-occupier. They were, again, nothing strategy from an investment standpoint, but they were priced out and were nearly in the market for 6 months before coming to me. They were not sure on what suburbs they wanted to buy. This was bought in Greater Sydney outskirts, off market, 4 weeks. 5 inspections done. All inspections were done by me. Only this inspection, they came in with me. And that means I also helped them in saving time. 900K, we were able to knock off $35,000 of the purchase price. I don't think one can get a better asset than what's valued here currently. Awesome. Shiv, if you can play this video, please. It's just to show a bit more examples on what has been purchased. Awesome. Thank you so much, Shiv, for that. And these are some client success stories, which of course are available on internet, and you can definitely go and check those reviews. Look, the intention here is to explain it's not just one example. There are several examples where 3 to 5% is easily knocked off on the purchase price itself. And even on the smaller assets, there can be a balance of both growth and cash flow. And this is where a strategy is really important and how a professional can make a difference to your buying journey. That's all pretty much from my end. Shiv, if you can go to the last slide. Again, I'd love to stay in touch. You can be in touch with any professional. All details will be shared with you anyways. Thank you so much for your time.